This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
The vested interest episode number 3. Really excited today, of course. We have so much to talk about. Benjie, Lloyd, and special guest Jeff Haas is joining us today. But as a starting point, Jeff, great to have you with us here. How's everything going on your side? You're a free agent now, passed at DraftKings, of course, but a free bird. How does that feel?
It feels great, not subject to any non-competition agreements or other restrictive covenants following a period of employment, which basically means I can go do whatever I want, which is awesome.
Exciting stuff, guys. And let's jump straight into it here. We have obviously breaking news that came today at the time of this recording, which is of course that ESPN has signed a license agreement together with PENN worth almost $2 billion that stretches over 2 years. We've all read the story, of course. It's huge news. It was rumored a couple of months ago, like 9 months ago, that DraftKings were about to sign this agreement with ESPN worth $3 billion, but that seemingly fell through. And now, of course, PENN has signed this agreement. So, Benjie, perhaps starting with you, can you give a bit more context to this story and what's your just initial thoughts here?
First off, we see some adherence to market realities here. It was $3 billion 9 months ago. It's $2 billion today. So speaking to some of the sign of the times. But look, from PENN's perspective, they're trading one partner for another from a branding perspective. You go from Barstool to ESPN. ESPN's obviously a huge upgrade. You look at it from a PENN perspective, they're now close to $5 billion in on their digital spend. I guess $4.5 billion in. And I think most of us would surmise that the initial $2.5 billion may not have been the optimal spend when you consider the dollar amounts, and many surmise that they overpaid for the score deal. I certainly would. Time will tell. Certainly, I think having ESPN as a branding partner will be an upgrade from Barstool. Will it be worthy of the $2 billion investment? I think time will tell.
Right, and
I would add
Yeah, go ahead, Lloyd.
Oh yeah, I'm just going to say, first of all-time great trade for Dave Portnoy, selling a company for over $500 million, buying it back for essentially zero.
Nothing.
Just a few years later, and some non-competes and restrictive covenants and all that. As Benjie mentioned, certainly an upgrade. I would add that beyond the market deteriorating, in theory, every day that goes by since the repeal of PASPA makes a potential ESPN deal slightly less attractive, in my view, because that's every day that ESPN betting-inclined users are signing up for DraftKings and FanDuel, and more importantly, developing behavioral habits that will be hard to break. So I'd argue that even without market deterioration, it makes sense to pay less today than 9 months ago, and less 9 months ago than 9 months before that. And the other, one of my primary thoughts here are, what will customer acquisition differentiation really look like for PENN? And what I think would really make this a step function change in their trajectory is it seems there's a decent likelihood that ESPN might get spun off into a direct-to-consumer standalone app and platform where you just pay a monthly fee to have access to ESPN. There's even a small chance, it appears, that ESPN might lead some sort of joint venture with a whole bunch of other sports content providers, aggregate together the ultimate bundle of sports programming, and offer that on an a la carte month-by-month basis. And if that is the case, and PENN says to their customers, if you keep an account with us, you get ESPN for free, or if you bet $10 a month, you get access to all of this for free, that I do think could be a really significant catalyst toward customer acquisition differentiation that others would have a hard time competing with. So over the longer term, that's the big thing I have my eye on is, can PENN subsidize consumers' access to ESPN and other premium sports content that can't be found elsewhere?
Right. I mean, now we are talking about like a potential like killer app here with PENN definitely differentiate themselves in an operator market that is becoming more and more commoditized. Right. The product is fairly similar to each other between the operators. Jeff, I mean, as an ex DraftKings employee here of many years, how do you see this deal? And do you see it positively, negatively? Is this a good thing, bad thing for PENN?
First, just to comment on what Lloyd said, I mean, you're really looking at bending light with those comments, seeing around a lot of corners. You'll be very curious to see if that's how things materialize, because I agree with you that the value proposition on that could be really strong. Pierre, just to be clear, I don't speak for DraftKings. I don't represent them at all. I think that this deal is probably one that DraftKings turned down, certainly at a $3 billion price point and probably at a 1.5 price point. ESPN as an acquisition funnel for sports bettors is a constant, but probably has diminished in its overall value after years of having promoted sports books. So I feel that the DraftKings team are probably fine with it. Short term, of course, the share price has come down, but I imagine they'll come back, stronger than ever as a result of what they're working on. So, overall, pretty good outcome for DK in the long term. It just creates another big potential competitor in the marketplace. But PENN have not outperformed in respect to the value creation from their digital investments to date. I know the score is a significant step up from their previous technology, but what happens on week 1 of NFL if they can't stay live during a crushing amount of traffic? A lot will be told about this story over the next 4 or 5 weeks.
So Jeff, that's interesting for sure. You mentioned the stock price here, and as you point out here, in the time of the recording, DraftKings is down 9% right now on the stock market, whereas PENN is up about 8%. So you can see a clear difference there in how shareholders are reacting to this news. But Lloyd, if you were a public market investor, which stock would you buy today with this response from the shareholders? Would you buy PENN at the moment that is up 7%, or would you buy DraftKings that is down 9% on this news?
From a purely expected value and market dislocation standpoint, without any respect to fundamental analysis of the businesses, it seems askew to me that DraftKings should be down so much. It reminds me of the times going into the pandemic when the NFL would announce that they were canceling or postponing a game and DraftKings stock price would drop 10%, as if that really was going to decrease their future cash flows on a net present value basis by anything even close to 10%. So again, not saying anything about the underlying quality of the companies, but on a short-term basis, there doesn't seem to be any real rationale why DraftKings should be down as much as it should be. And this probably will either be proven right or wrong by the time this podcast is released. But all other things equal, one would think there's some sort of mean reversion that has to take place, and that DraftKings is being a bit irrationally undervalued by people who are overly reactionary or perhaps not properly understanding the news.
I'm with you, Lloyd. Sorry, I was jumping. I'm with you, Lloyd, on that, and to Jeff's point earlier in regards to DraftKings not necessarily being overly concerned because they walked away from this deal. I think when you look at this transaction in terms of the PENN situation, I think that with both parties, it's almost like a bridesmaid type of deal. I don't think this was like a perfect marriage for either party where it was their intended desired partner initially and the perfect situation. I think it's more a scenario where the DraftKings deal didn't work out. They looked at all of their other options, and from an ESPN perspective, PENN was the only suitor that was available at a reasonable price point. And I think from a PENN perspective, you look at the deal and, some of the things that they were working on in digital spend, again, as Jeff alludes to, maybe didn't work out as well as they'd like, and this became the best upgrade opportunity for them. But kind of a marriage, not necessarily of ideal, but almost like a bridesmaid situation where it's your second choice.
Yeah, from a public markets perspective, I would argue that the real winners here are the affiliates, the major companies there, because this has the potential to disrupt what has been an increasingly more rational environment for customer acquisition. We could end up seeing, another, at least short-term arms race over the first few weeks of NFL. I mean, what are CPAs going to look like?
But is that actually the case? I mean, ESPN Bet presumably will source their customer acquisition through ESPN channels primarily. Do you not think that players entering the ecosystem through the affiliate channels, it wouldn't end up actually hurting the affiliates, the fact that ESPN will be able to do acquisition straight without affiliation?
If they've been working on this properly over the last 6 months while they're working on getting the paperwork done and making the announcement, and they come out with all guns blazing, then sure. Will that be the case? Let's see.
Yeah, I mean, you would assume that in the market that this is part of the strategy. Again, that they are not necessarily looking to spend more money on affiliation when they are paying $1.5 billion for ESPN, the ESPN licensing and everything that comes with that. I think it seems pretty straightforward, no?
Yeah, nothing surprises me about M&A preparation.
Right, fair enough.
Or lack thereof.
Or lack thereof. I mean, another part of the deal, of course, is that Penn is giving Disney the option to buy. I think it's almost up to 30% of Penn as a company in a 10-year deal. So they're obviously giving away potentially a significant portion of their equity. What's the reaction to giving away so much equity on kind of standing and falling on this one deal? Is it benefiting kind of Disney more than it benefiting Penn? Any thoughts in general on this like huge stock options that is being given away here? Perhaps Benjie, if you want to start.
Yeah, look, I mean, does it benefit one more versus the other? I think it's a situation where, from an ESPN perspective, it comes back a little bit to what some of the Lloyd's commentary was earlier. If they're going to be, if they're going to be pursuing a strategy, which they should be, where they become more digitally focused, and they feel that the Penn asset fits well into that strategy, more so on a long-term basis and on a 2-year basis, then ownership from their perspective seems to make a lot of sense, is how I would categorize it. And having as much of that company as possible within this deal makes sense based on that strategy. So part of it is skating to where the puck is going, what bit as Lloyd alluded to in terms of what ESPN's digital strategy is and where Penn would fit in within that.
Right.
Yeah, I think Disney is a much bigger winner here than Penn. $150 million a year, sustainable over 10 years, in order to have a guarantee on sending out traffic for sports betting is a very expensive proposition. And realizing value on that is going to be hard. And then from there, cross-selling them into iGaming, where they're actually going to have a chance to recoup, is also going to be a challenge. It requires a lot of execution, better products than I've seen in the legacy landscape. But let's see where they end up coming from here. The other interesting point is, maybe they take 30% of Penn. They still own 5 or 6% of DraftKings. That makes Mickey Mouse one of the biggest sports books in America.
MickeyMouseBet.com eventually, who knows, on the iGaming side.
Well, what they should do is ESPN Bet and then Mickey Mouse Casino.
Exactly, iCasino and Sportsbet, exactly, separate the brands. I mean, speaking of that, Penn has outlined kind of the targets that they are looking to achieve with this deal, and they are outlining a plan to reach $1 billion EBITDA by 2027, and reach a 20% market share on online sports betting and 16% market share on online casino share. So these are very aggressive targets that they have outlined here, of course, considering where they are today. Is these targets realistic? I mean, is ESPN gonna tilt the scale that much in their favor that they can achieve this type of market share only because of this brand, Lloyd?
I don't know if I have thoughts on specific numbers like that. There are, investment bankers and equity research analysts better positioned than me to opine specifically. I think it comes back a bit to what I said before. If this is simply a customer acquisition channel that will result in some extra logo placement and display banner ads, probably not. But if Penn uniquely leverages the one-of-a-kind asset that ESPN is, perhaps in the way I described before, by subsidizing access to some sort of subscription video on demand package, perhaps by integrating betting opportunities into live streams on the ESPN app and doing all sorts of interesting product innovations that one could be uniquely positioned to execute on in a partnership with ESPN, that's what I think it takes to achieve any sort of outsized EBITDA or profitability targets. I do not think this deal will be a win for Penn if it's simply about, banner ads and logo placement. And I certainly doubt that it is. I'm sure there are many people internally who have much loftier aspirations and are working quite diligently, talking to potential M&A and white label partners that can help bring something truly unique to the table.
I think whether they hit those targets also, Pierre, depends on when California opens, when Texas opens, when they go into New York, et cetera, when Penn goes into New York.
Yeah.
Right.
Yeah, Penn, they have some super smart people working in that business. And clearly the board have given their approval on this transformative deal. And so ultimately it comes down to execution. I love Lloyd's ideas. They should just take all of those. But also, what are they going to do with physical points of presence? Retail sports books on the site with the casinos, ESPN Bet. Will they consider having live broadcast studios in and around those sports books, integrated live gaming next door? I mean, really, it requires, rabid ideation and a lot of creativity and smart people coming out there and, a moment of introspection to find out why they overpaid so dramatically for all of their previous digital assets and what they're going to do different this time. If they're having an honest conversation internally about how to improve upon historical results, they have a chance. But 20% market share seems incredibly unrealistic and improbable, particularly given, Bet365, moving more aggressively, and Fanatics, who will do their best, and we'll see how it goes. But I think there's a very low probability they hit that market share target, but EBITDA, who knows?
And it's a good point, Jeff, because you talk about Bet365, all of their competitors are moving at lightning speed, right? And, here they are, they're in the thick of it. They're still working through, from a technology standpoint, bringing to life that new platform that they brought in from the Score and all the challenges that come with it that we'll see come to light this football season potentially, and integration of new product that can augment their deliverable and help them stand out in some capacity. One would surmise that the ESPN folks, while big picture guys, may not understand the intricacies of those aspects of this transaction and where the product lies from the sportsbook standpoint on the product and technology side. And there's just a lot of challenges to work through short-term operationally, completely independent of anything that goes on in terms of the ESPN partnership and how they monetize that.
Agreed. What will be also really interesting is there is that third license available in Connecticut now, if partnering with a lottery. ESPN based in Connecticut, are surrounded by DraftKings and FanDuel advertising. If they can get that license, I think that creates a really interesting focal point for them.
It's a great point. Very interesting to know, as Jeff alluded to. I think these are some of the two things I'm watching. What happens to that third Connecticut license, and what happens to Disney's stake in DraftKings? Not necessarily consequential to some of the other factors we're talking about, but really interesting dynamics that I am incredibly curious to see how they play out.
But what was the background there, Jeff? Do you know why Disney invested in DraftKings in the first place? I know that DraftKings used to have an exclusive agreement on advertisement on ESPN back in the fantasy sportsbook days. Is that why DraftKings decided to invest? Why Disney decided to invest?
Yeah, I would say subject to fact checking, but my recollection is that it was a media for equity deal in respect to DFS for an older media property acquired by ESPN or Disney during some of the restructuring, and they chose to maintain that shareholding over time.
Interesting. So let's move on now. Really interesting here with Penn, of course, and I think the summary of this seems to be that depending on what they do with the product, not only the customer acquisition is what's going to kind of tip the scale in or against Penn's favor. Are they going to take Lloyd's idea to heart and integrate potentially ESPN Plus, let's say, within ESPN Bet against turnover requirements or something like that, because then they have an incredible proposition when it comes to product. Otherwise, they are left with only the acquisition funnel, but maybe the players who are not going to stick around to a subpar product, basically. So really interesting to follow that. Going on to the next point, we've seen a lot of quarterly reports landed now, pretty much all of them except for Entain and BetMGM. However, even BetMGM have released some numbers through the parent brand, of course, which is MGM. And what we've seen now is basically online sports betting in the US turning the corner. All of the major tier 1 operators, except for PENN, ironically enough or not, is now profitable in Q2 2023. That includes FanDuel, DraftKings, Caesars, BetMGM, and RSI, all showing EBITDA positivity in Q2 of 2023, except then for PENN that made a small EBITDA loss, although they are close to break even there. So kind of leave it open a little bit. Benjie, perhaps starting on your side, looking at the reporting season here so far, and the industry turning the corner, what's your general feeling here now as we go forward? Is there anything that stands out in the individual companies to you in these reports? And do you feel that there is a change of sentiment now? The industry has proven itself. What's your thoughts?
Well, I think I'll start with kind of the big macro trend within all this, which is it's ironic, or it's interesting to me that all this happens in Q2 of 2023, which kind of represents the turning point of the 5-year anniversary of the PASPA repeal. And the first 5 years were fraught with, while there's incredible highs and lows as it pertains to market dynamics, just a whole lot of spend and a whole lot of losses, understandably, to get where we are. And what those companies were preaching at that time, we're now seeing come to fruition. What they were preaching is, we're investing today for a future which will arrive tomorrow. And tomorrow is now arriving, that we've reached the 5-year mark and we turn the corner and we see all of these companies achieve profitability for the quarter for Q2 2023. And it speaks to rosier times ahead in 2024 and beyond. So from a big picture macro perspective, I think it's really interesting to look at it from that first 5-year dynamic shifting into that next 5-year dynamic from a timing perspective.
Right, and it feels almost like, if we back up the tape a year ago, which is kind of almost like the low point of the industry, in just a year's time, the sentiment has changed from investors kind of turning their back against the industry. Obviously, we saw the low points in DraftKings share price, for example, which have more than tripled since then. And now, of course, the investors are showing much more positive sentiment here. Is this surprising that profitability came kind of this early, let's say, in this quarter to you guys? Because obviously, many of the operators have communicated a year or two ago that they would turn profitable in second half of 2023 or 2023 as a year. But now that it actually came true, it seems almost like investors are surprised that this happened. Again, do you guys see this as a surprising turning point that is happening now? Lloyd, perhaps if you want to start, and also feel free. Are there any other kind of bullet points or any interesting things that you picked up from the reporting season so far?
I don't think it's terribly surprising. Not that I would have necessarily predicted this exact moment in time 5 years ago. But first of all, Jason Robbins and the team have been saying on every single quarterly earnings call since 2019, right, guys, we have the data, we have a playbook, we're analyzing our CAC to LTV, and we're going to get paid back on our customers in about 2 to 3 years in each state in which we go live. Give us time to make that happen, and you'll see we're going to make it happen. Look back at the previous projections we've made. We've hit all of those targets. And so if you ask the guys at DraftKings, they'll probably say, we've been telling the same story this whole time. It is investor sentiment and the broader market that has been much more volatile. And I also think these things are deeply related. In 2020, 2021, a lot of investors piled into the space, probably who didn't truly understand what it was they were underwriting. Everyone was piling into growth assets without much regard for current profitability. As the market started to turn, suddenly in every industry, investors were saying, wait a second, we need to see direct paths to sustainable free cash flow generation to keep underwriting these companies. And I think public company management teams took those indications to heart and probably accelerated the rationalization of marketing spend and focus on unit economics. And in part, we're seeing that all come to bear now. So not terribly surprising. I think it's a pleasant upside surprise. DraftKings had really lofty expectations and analyst consensus estimates that they blew by. And just to touch upon the other point you asked as you turned it over to me, in terms of anything interesting, again, not necessarily surprising, what do all the operators now, and even including Genius, who had solid earnings on the B2B side, what are they all reporting? Higher structural hold rates, higher parlay mix average, more average legs in each parlay, higher percentage of handle composed by parlays and micro bets and other high margin products. And so I think we're now also starting to see product differentiation, most of which, frankly, has been supplied by startups and early stage companies, making its way through, bringing this industry into the 21st century, modernizing the experience for the younger, instant gratification seeking customer. And that's resulting in higher ARPU numbers and higher margin rates.
Yeah, Lloyd, that was exceptionally well said, sir. Kudos on that. Agree with all of that. I would add two things. One, in respect to Benjie talking about the 5-year anniversary of sports betting in America, of legal, regulated, locally regulated sports betting in America. But it's also the 10-year anniversary for iGaming in New Jersey. And you look at the companies that are profitable today and leading today and all the revenue being generated from iGaming. I mean, that has to do with, Borgata and Boyd, launching their first online casino and Golden Nugget going in as well. And Thomas Winter, who led Golden Nugget and built that into a Leviathan for online casino in New Jersey, that's now part of DraftKings. And, one of the things that surprised me, well, maybe didn't surprise me, but impressed me, was slide 7 of the DraftKings quarterly results, where they talk about what they're doing to differentiate iGaming and how they're leading. They've just launched or are about to launch their new live casino product, and they're doing a lot of really interesting things. I mean, we talk about sportsbook because it's sexy, but what is propelling a lot of these businesses is their success around iGaming, and Entain and Flutter and DraftKings and Rush to a certain extent, are really outperforming there by, focusing on operational excellence. And I think, again, when we bounce back to Penn and Disney, that deal, are they going to hold a candle to that? Because again, they're so focused on sports betting, what's really happening underneath that, which is going to propel them towards their EBITDA targets.
Right, they communicated 16% market share on the iGaming side, even though, as you point out here, Jeff, ESPN is a heavily tilted sports betting brand. Something else to take note of in the quarterly report, actually, something a bit funny. Both DraftKings and BetMGM are reporting that they are the leaders in market share on the iGaming side, which is quite interesting. And the way they outline the competition is completely different from each other. And even FanDuel is reporting much higher market share on the iGaming side than what BetMGM is assuming that FanDuel has, for example. So there's a little bit confusion there who is actually the market leader. I don't know what numbers you guys have seen, but is there any way to figure out what is the actual answer here? Can we believe BetMGM? Should we believe DraftKings? Who are the leaders today in iGaming? Yes.
Yeah, I think you need to look at the regulatory landscape and who is live where, because DraftKings and Flutter are live in Connecticut,
right,
and Entain isn't. So they're all going to use the fine print to say we're leading in the markets where we're live. DraftKings are also live in 2 states on a monopoly basis, but not live in Nevada, where Entain are to a certain extent. So, it isn't apples to apples, which allows everybody to say they're number one.
And
this is why it's often said that the greatest lies are told in Microsoft Excel, not in Word or PowerPoint, because of exactly the finessing that Jeff's referring to over there.
And look, that's an evolving story. Does it really matter who the leader is today? You've got a handful of states that are offering iGaming. It's going to be a much bigger part of the equation in the years ahead as gradually we see more and more acceptance of it. It'll be interesting to see, Lloyd, you alluded to a little bit earlier, some of these startup companies that came in with some product innovation that's geared more to that next generation of bettors, and some of that product making its way in. And as those sportsbook products continue to evolve and improve, and how that will play in terms of investor sentiment, but also on the iGaming side, we're still early days there. Where will the innovation come from on that side, and how will that play into the overall story going forward? So a lot of interesting dynamics as we look at the upcoming quarterly reports, which one would surmise will continue to get rosier and rosier. And I think the other question within all that is, where will that impact investor sentiment, and how will that impact the return of not just small to mid-sized VCs and or angel investors like myself and Jeff, but some of the other venture capital and private equity, and whether or not that will make its way back into the space as they see the proof of unit economics playing out in quarterly reports that come forward.
And I would just add a quick point, about startup-led innovation. It's funny at this point, and I know there's a lot of founders who listen to this podcast. people talk about Simple Bet as if they just obviously are building a product that everyone wants and needs. But I'm telling you, in the early days of Simple Bet, when it was operating in Joey's one-bedroom apartment in New York City, I cannot tell you, and I think Benjie knows this too, how many people who said they were, the world's leading experts in sports betting and who built businesses in sports betting in Europe for 20 years said there was no chance anyone wanted micro betting. There was never going to be any interest in it. No one was going to bet over these short durations. It was not going to happen. People with all the confidence and gravitas in the world just completely dismissed everything Simple Bet was trying to build. And that is often the story of, people who build what end up being really transformative businesses, is that until you actually break through, there's going to be tons of people dismissing you and saying it's not going to happen. And, the onus is on you. And certainly Simple Bet has succeeded in this regard in showing that your vision really does have merit. And if you understand the consumer, you can bring something unique to market.
Yeah, agree. What's also interesting, dark horse in the race, which we haven't talked about, and I don't really see people talking about very much, is Bally's. I know they remarkably underperformed to date, but they own GameSys. And GameSys are one of the world's leaders in respect to online casino. And once they get more organized and start executing at a higher level, they could be doing some really interesting stuff in America too.
I agree. Anyone who knows Soo Kim will tell you he is a really progressive, forward-thinking, out-of-the-box kind of guy. And perhaps the operational aptitude of the organization and maybe some of the specific corporate development decisions have not quite gone as planned and could have been tactically reimagined in retrospect. But I do think it's a great point. You got a strong executive team, a lot of funding behind it, a long time in the industry. No one is really talking about Bally's today at all.
Fair point. And if you look at a few of their missteps in the early days, which were probably $250 million totals worth of missteps, we have to hope that for Bally's, it's that the axiom, it's not how you start, it's how you finish, certainly holds true.
Yeah, that's gonna hurt. And Lloyd, to your point here about Simple Bet earlier, it's typical pretentious Europeans here. Don't listen too much to what we say. Unfortunately, Joey understands that as well. But we're gonna stay in the startup landscape a bit now. The time is working away from us here today. And Lloyd, you brought up this point that you wanted to talk about today, which I think is absolutely excellent. As a startup founder, I'm gonna sit back and enjoy this conversation a bit because we have three excellent investors here today. And Lloyd, you wanted to talk a little bit about kind of from an investment point of view. You sit in a lot of interviews and calls with startup founders who are trying to pitch their ideas to you, and you have picked up on a couple of reoccurring kind of mistakes they do, or let's say lies that they tell the investors, which obviously is a massive turnoff for an investor to hear. Can you talk a little bit more, give a little bit more background to this topic, and can you start off here? Kind of what discussions you have with investors that you don't like?
Yeah, so I think there's a lot of coverage of the startup and venture capital space, but very little of the dance that takes place in private between founders and investors when negotiating and pitching an investment. And this topic was inspired by a talk that a venture capitalist named Bill Reichert gave at Stanford Business School in 2009 that is definitely available on YouTube, and I'd highly recommend. And it describes the top lies that founders often tell VCs. And the word lie is not meant in an accusatory manner. It's meant to describe the fact that on the one hand, founders know they have to be really enthusiastic and ambitious and confident and show investors they can produce outsized returns. And on the other hand, investors want to see someone who's grounded in reality and has credibility. And between those two tension points, sometimes in the middle ground, I do see founders misstep or stretch the truth, even if inadvertently, in ways that I think is counterproductive. And there are many different common examples of this. I'll kick off with one, and I bet as soon as I do, Jeff and Benjie will laugh and say they've seen the same things over and over again, and we'll have theirs. I think one of the most common, quote, lies that I hear from founders is, we have no competition, we're the only ones doing this. And the reason that I think ends up being counterproductive is that, first of all, if it is true, if you really are doing something no one else has ever done, you either are one of the smartest people in the entire world, or you probably are pursuing an idea that's not worth pursuing, and that's why you're the only one doing it. The most successful companies you've ever heard of were not the ones who invented their business model. Facebook was not the first social network. Google was not the first search engine. Uber was not the first ride-hailing platform. They were just the first one to reach critical mass when everyone had GPS-enabled phones in their pocket, etc. Sometimes what I see founders do is they narrow the scope of their business so much as to be insignificant. If someone says to me, we're the only Web3 online sportsbook catering to senior citizens in Alaska who want to bet on competitive ice fishing, that may well be true, but it's not really valuable that it is the case that you're the only one doing that. And then that leaves what is often the case is that in reality, the company just didn't do proper research on, their competitive set. And of course, that is not good for credibility. And I won't name a company specifically, but I was talking to one not too long ago who was pitching me on a particular idea. And I asked about their competitors. They said they had none. They had a slide with 4 quadrants. They were up on the top right. There was no one else near them. And it turned out not only were there many competitors, the market leading competitor had the same name and the same slogan as they did. They had not even Googled their own company name or slogan. And so I know people want to tell investors they don't have competition. They feel like it strengthens the case. But I have many more. And I'm sure, again, both Benjie and Jeff have seen exactly that one I described. Before going into others, I'll let the other guys get a word in edgewise here. But that's the type of example I was referring to and the type of thing founders say often that they might not realize actually is counterproductive to their efforts.
But Benjie, take it away.
First of all, that was a good one, Lloyd. I mean, and I do hear it all the time, and it's a no-win situation. To your point, if no one's doing what you're doing, it's probably not worth doing. No one's doing it for a reason, and of course, someone else is doing something just like it or very similar. I think one of the ones that I often hear, and to your point also, Lloyd, it's not so much lying; it's a bit more their vision of the world not being as expanded as it can be, or a bit of naivete. And I often hear along the lines from folks that are pitching ideas. We're in the process of signing a deal with DraftKings or FanDuel or Genius or Radar on the B2B distribution. And, look, we have channels where we can double check how close they actually are. And, having had a conversation with a mid-level manager within the ranks of one of those organizations doesn't necessarily categorize as close. I guess one's definition of close can vary depending on your view of matters. But, in many instances, not only is this signing not imminent, it's not even past the introductory or mid-manager level. And then you have other instances where a deal may very well be in the works with, on the B2B side with a supplier, but at really, really onerous terms. And, sometimes the way in which those things are being positioned could be categorized in a little bit more of a, I don't want to say a more transparent manner, but you got to use a grain of salt in terms of how you present how close you are with some of these opportunities, is what I would find in oftentimes in conversations with founders who are somewhere along the line in their business objectives.
Yeah, I hear that one all the time as well. Oh, we just talked to so-and-so at DraftKings. They're thinking of buying us. Oh, I just got off the phone with Benjie Cherniak. He's planning on investing. Obviously, I'm going to text Benjie as soon as you say that and ask. And sometimes Benjie says, oh, yeah, like those guys are awesome. I am investing. Let's have a call. But other times, something quite different is the case. And
well, I think one time I replied, which company was that? I'm not even sure if I'd heard of them.
Right. And I should mention, even when you're not talking to insiders who have this connectivity, a venture capital and even angel investment takes quite a while to negotiate and close. If you tell an investor you're going to do something 15 days from now, and you're not going to close the round within 15 days, you better hope that you actually achieve that milestone by the time you come asking for signatures and wire transfers. So again, I think a lot of self-inflicted errors that I often see come from this exact variety that Benjie mentioned.
I mean, just as from the other side of the fence, preparing a pitch deck as a startup founder and preparing your pitch to investors, there's like a little bit pressure there to stand out in some way, because we would assume that you will get 100 pitch decks a week, let's say, and how do you get even the call, or how do you find the interest there? So I don't know, is there like something to bending the truth ethically in some way, or should you be straightforward from day one, lay out the lines, or should you try to kind of tell the most interesting story within reason, let's say, Benjie?
Look, my view is,
how do you get the interest?
Yeah, look, I mean, it's a delicate answer, but for me, it comes down to transparency. If I'm dealing with an entrepreneur, it's all about. It's of course it's about the idea and what they're trying to do and how they're going to do it, but it's also about the entrepreneur themselves, and it's about them and their integrity. And I think that if they're coming out and and coming to with forecasts that are unrealistic versus coming out and saying, look, you're asking me for some sort of forecast. We all know it's my best guess, but we don't know what the future will hold in terms of sales. I'd rather hear the transparent and truthful answer than something which is geared towards what they think I might want to hear, but we can typically read through that. So for me, the more transparent I believe a founder is, the more that I'm going to hold them in high regard, and the more likely I am going to be to want to align with them in some capacity and helping them in their journey.
But a quick question here: do you assume when you see a forecast, any forecast, that it's exaggerated?
I do, absolutely. And look, there's a bit of like a game that gets played. The first entrepreneur ever probably did put conservative projections forward, and the first investor ever probably believed them. But then that entrepreneur missed those projections, and the investor realized, okay, I have to discount these projections a bit. But then the next entrepreneur realized that their projections were being discounted, so they had to exaggerate them even more, and then they missed those, and now here we are. Guys like, I think Gary Tan at Initialized Capital says he adds a year and multiplies by 0.1 on your year 5 revenue. So he assumes that whatever you're projecting in year 5, you'll make 10% of in year 6. And I definitely think there is something to that, but really more to Benjie's point, at the early stage, it's so much more about the people and the relationship. All of the best pitches that I've been a part of, whether raising money for my fund or investing in other companies, have not used a pitch deck at all. You get on the call and someone says to you, tell me about yourself and what are you building and why? And you just have a conversation where you get to know the essence of the person. And, I always ask myself when investing, is this a person whose earnings I want to own a future stake in, regardless of what they're pitching me right now? And are they someone that makes me so excited about what they're doing that I want to quit my job and go work for them instead? And neither of those questions have anything to do with numbers or EBITDA projections. Quite the opposite. Being credible and honest and transparent probably heightens the likelihood of answering yes to both of those questions. So I do appreciate why founders, especially without the network to get a warm introduction, are tempted to put more eye-grabbing numbers and statistics on a page. But ultimately, I think it compromises your credibility over the long term. And at the early stage, investors are making a bet on you as a founder and as a team and on the size of the opportunity, more so than what your year 5 operating margin projections are.
I agree. But fictions aren't necessarily just about saying, I'm having this conversation or going to conduct M&A with this party. It could also just be around, how you actualize your aspirations. And for me, the greatest fictions and most interesting narrative is often created around, TAM, SOM, SAM, because people talk about, what percentage of what market they're going to have, where they end up saying they're going to reach more humans than have existed on the planet. But at the same time, I've been on the other side of that. I ran Poker Stars in Asia for years, and the question was always asked, how big can this be? So, my estimates were based on, 2% of China, based on whatever the ARPU was going to be. And of course, that was absolutely unachievable, but you still need to have your North Star in order to say, here's where we want to get to.
But oftentimes, Jeff, that North Star will be if we could achieve just 1% of market share, look at the numbers and what they would look like. But if you're shooting for 1%, you're never going to get there. So you want that entrepreneur to be shooting higher than that. So again, a lot of it comes down to the makeup and the determination of the entrepreneur themselves. But transparency is for sure the name of the game.
Yeah, and this bounces back to a point we talked about half an hour ago, which is, the PENN board approved that deal based on 20% market share targets. Also unachievable, but they needed to have, a target in mind that was ambitious.
Right, even PENN is bending the truth here. So that's a fairly small startup. Fair enough. Aim for the stars and maybe you'll reach the moon, but reaching the moon is pretty okay as well, let's say.
People say that,
Lloyd,
if you aim for the moon or for a star in real life and you miss, you're just cast off into an endless vacuum of space and not likely to just happen your way to another celestial body. So I do think that gets thrown around a bit too frequently as a motto for this exact mentality. But sorry, I know we have a few minutes left here.
Before you get to it, Pierre, the last thing I will just say in closing out this topic is I think it also cuts both ways, right? Like we're talking about the quote-unquote lies or exaggerated truths that we might hear from entrepreneurs. I'm sure all of the entrepreneurs are listening, some who have raised capital, saying, hey, hang on a sec. What about some of the blank promises that I heard from investors or exaggerations that I heard from investors in terms of what they can bring to the table to help me in my journey? So I do think it cuts both ways. It is worth mentioning that as we close this topic.
Yeah, I agree. And I think courtesy becomes incredibly important there. I spent 2 years working with Meredith McPherron at Drive by DraftKings, and I'm now a venture partner at Dreamcraft. And the morality with which they approach their obligations towards entrepreneurs is something I've been really impressed by. Trying to provide appropriate commentary, doing what they said they would do when they would do it, and being respectful with a no that can be quick if necessary. A lot of that, sets a tone for how I engage in my own angel activities, but those are still, very minor compared to what the other funds are doing.
I should mention, Y Combinator, arguably the most successful startup accelerator program in history. They maintain internally a database for founders of all the investors that have ever invested in other Y Combinator companies, and they're all ranked basically according to the level of courtesy that they exhibit toward investors. And I think the absolute lowest ranking is called something like don't take money from them unless you absolutely need to, all the way up to something much more favorable. And that is a productized, formalized way of transmitting reputational concerns, but it also happens in a less formalized way. And so perhaps we even do a segment on a future episode, the flip side. What are some of the most common empty promises that some VCs can make, and how can founders go about determining the caliber and level of courtesy that the investor they are working with is likely to expend.
In closing of this topic, I just want to say thank you, Lloyd, for shooting down my mother's favorite mantra that she taught me here. So she'll be happy to hear that for sure. So on to the last topic of today, guys. As is tradition in the Vested Interest podcast here, we're going to close today with a deep dive of a specific company, not necessarily a startup today, but we want to talk about GeoComply. Obviously, GeoComply has been around for a long time, but it kind of felt like they found their home in the United States now with the legalization of sports betting there and the ring fencing around the states. So I just want to kind of open the topic here. Lloyd, starting with you, what do you feel is the current status of GeoComply? A lot of interesting things here. They recently acquired OneComply. What does the future look like? Can they grow even further? What are your thoughts on GeoComply?
Yeah, I'll kick this one off because I do have to drop in 7 minutes, even if you guys are please welcome to continue talking. The thing that strikes me most when I step back and look at GeoComply is that there were quite a few people in the world who had an eye on the U.S. legalizing PASPA in advance of May 14th, 2018. But I don't know if anybody successfully monetized that viewpoint to the extent that David and Anna at GeoComply successfully did. And I think a lot of us would like to think that if we were in the right place at the right time for some tectonic shift in market dynamics, we would know, exactly how to monetize that. But there are a lot of smart people who could have built businesses in advance of the overturning of PASPA, who either did not or certainly did not to the extent that David and Anna did. And I think they just deserve so much credit for the hustle and the foresight and the insight and the executional aptitude to really front run a major change in consumer dynamics. There are very few opportunities most entrepreneurs have in their life to do that. And now we're at a position just a few years later where we're talking about them as a dominant player and what other verticals they might go into. And I think there really are two obvious areas of expansion. One is a bit more vertical, the other horizontal. The former, acquiring OneComply, which Benjie was an early investor in. So congratulations to him on that exit. And anyone who knows Cameron, the founder, will not be surprised he was able to effectuate a successful exit so quickly. He's an absolutely great guy. But you'd imagine that they may be interested, they being GeoComply, in expanding into other aspects of the reg tech stack that would be complementary and bundled into a unified offering to an operator who has various needs adjacent to their geolocation needs. And then the horizontal form of expansion would be into other highly regulated industries that require precise geolocation, crypto trading, various types of financial trading, even other industries that are highly regulated and have geolocation requirements, whether federal, regulatory, or otherwise. Those would seem to be the areas of expansion. And given who GeoComply is backed by at this point from an investor perspective, I think they have quite a formidable war chest and group of investors and board members who are willing to underwrite some of these M&A transactions that could lead to interesting types of expansion for the company. So hats off, of course, to David and Anna for front running the repeal of PASPA, arguably to a greater level of success than anyone else has been able to achieve. And it may just be that they've only scratched the tip of the iceberg, and through some combination of horizontal and vertical integration, they will continue to expand and 5-10x the business from here.
Yeah, these are a really smart set of founders, and they weren't building in anticipation of PASPA. It precedes that by 5 years, because they were live in New Jersey at the end of 2013 when online casino launched for the first time, and online poker. And I worked with them at the time on a project I was involved in. The smartest thing they did when they were starting their business was they put a display monitor of all the pings and all the successful authentications into the DGE office. And I'll tell you, the number of times I went to the DGE meetings, both in 2013-14 and then again in 18 for DraftKings, is every time you walk through their office, somebody is showing you, hey, have you seen this? And they would sit and watch it in real time, like it was, watching the oracle foretelling the future. And to a certain extent within our industry, it was because they positioned themselves as, the strongest player across the industry who were providing, access to every single transaction. And it's not just that they're really good on technology and relationship building, which is key. Their leading investment into public policy advocacy has ensured, streamlined entry into all of these different markets. And the focus has been North America, evidently, but this can very quickly go global, both as a result of having a great product, but also, I think that public policy advocacy can lead towards, creating inroads with which they are uniquely positioned to fill.
Look, we could spend an hour talking on this topic alone, and echoing the sentiments. These founders are the real deal. There's no question about it. And they may not have a monopoly on the space. There are some competitors emerging, but talk about a first mover advantage. To your point, Lloyd, and to yours, Jeff, they got ahead of this back in the 2011, 2012. So their first mover advantage as it pertains to the gaming space will not be overcome. There certainly is an opportunity beyond the bounds of North America, and one that I'm sure that their private equity backers are in tune with and expand and looking at. And I think that before they start looking at other verticals that they can go into, whether it be crypto or other, and I'm sure that eventually they can, given the quality of the founders and the base that they've built, I think that the RegTech roll-up kind of strategy makes a lot of sense. And I don't think any of us feel, look, I don't have any inside knowledge as to what they're looking to do here, but the acquisition of OneComply feels a lot more to me like the tip of the iceberg than it does an endpoint. And look, acquisitions can be a bit of an art. You got to make that first acquisition, get the integration done, start with something, I don't want to call OneComply small, but smaller than some of the other opportunities that might be out there, and prove that you can get good at acquisition and integration, then move on to number two and, whatever other targets are identifying. But I could certainly see a pattern emerging here where we're talking about OneComply and their growth via market share, expanding into new states and jurisdictions locally and globally, as well as M&A for years to come.
Yeah, I think what will be really interesting is to see what comes from their R&D efforts and whether they end up building more products themselves or acquiring, because they could have a centralized repository for ID verification. And that could either be based on a Web3 or crypto layer or, more legacy Web2 tech. Also payments. I mean, if you can have one integration for KYC, geolocation, payments, fraud detection, and, other hygiene elements of gaming and other businesses, I mean, the opportunities there for growth are phenomenal.
Right. What about the competitive landscape? Like, if you would try to make a case against GeoComply, what are their weaknesses or what are potential pitfalls for GeoComply? As you all point out here, it seems like they are in a very strong position at the moment, and they have a grip of the market, certainly in the US. But if we were to try to make an argument or some bullet points against,
one man down.
Yeah, one man down. Lloyd has left us here to another meeting, unfortunately, but we are still going strong here. A couple of more minutes at least.
I have to jet too, I'm sorry to say.
All right, fair enough. Yeah, but let's close off on that point. Perhaps Benjie, if you want to try to make a case on something against GeoComply, and then we'll close the episode for today.
Nothing I can say against them, other than that, from the competitive landscape perspective, by osmosis, some competitor or competitors will achieve some piece of market share. And competition will be good for GeoComply because it allows them to see what other things are other companies are doing and thinking, and allows them to sharpen their tool set to ensure that they don't get complacent. But yes, we have seen some competitors emerge. We all know who XPoint is, and they're going to achieve some market share, but it's not based on deficiencies or weaknesses in what GeoComply is doing, from what I can see.
Yeah, I think the competitive landscape could shift on them very quickly, and it's not your XPoint, but it's your WorldPay, very highly capitalized existing service provider to the industry who recognize that they're giving up so much of their lunch by not getting into geolocation.
Good stuff, guys. It's been an absolutely brilliant hour here. We went over a little bit, so we have to thank Lloyd from a distance here. But Benjie, thank you like always. And Jeff, thank you for coming on last minute here to give your thoughts as well. Fantastic.
Pleasure.
Thanks so much, guys.
Thanks, guys.
Have a good week ahead. I'm going on vacation. I'm off to Ibiza tomorrow, so I'll watch this episode on the plane. But yeah, thank you so much.
Bye,
thank you, guys.